Thank you, Kevin, and thanks, everyone. It's great to be here today on Long Island. It's always a pleasure to speak with the business community because of the leadership role you play in your communities and in shaping the economic landscape in this region. So thank you all for coming today. Over the past few years, I've been engaged in a series of outreach meetings all across the Federal Reserve District. For example, in 2010, I visited several upstate cities. Early last year, I made visits to various parts of the city, Brooklyn, Queens, the Bronx, and to Puerto Rico. And in August, I met with community and business leaders and elected officials in New Jersey, Newark, Patterson, Jersey City. And in November, I went to West Point in the capital region. I consider these visits just as important as the visits I make to Washington, D.C. to formulate monetary policy, or to Switzerland to help shape international banking regulation. Each visit within the region helps me to deepen the relationships with the people I serve. I believe that understanding the issues and concerns that I gain today will help ensure that Federal Reserve policy decisions will reflect the public interest in the broadest sense. Today I want to talk with you first about the Fed, what we do, why we do it. Then I'll provide some thoughts about the economic outlook nationally and regionally. How the economy performs is important in many ways. At a personal level, for example, it affects your family's finances. And for students, their job prospects when they graduate. Collectively, it affects the potential of our nation to confront and deal with many of the challenges that we face. As always, what I have to say reflects my own views and not necessarily those of the Federal Reserve System or the Federal Open Market Committee, which is also known as the FOMC. So by way of introduction, let me briefly review what the New York Fed does and what makes my job so interesting. I am vice chair of the FOMC, which meets 8 times a year in Washington to set interest rates and make other decisions about monetary policy. The members of this committee all strive to set policy to advance the mandate given to us by Congress to promote the maximum level of employment consistent with price stability. Now, sometimes we have different views about what we should do. You should view this as completely appropriate. These are hard questions, particularly at times like this. In fact, I think we make better decisions as a committee because we don't all think alike. But we are united in our commitment to our dual mandate and in our belief that Fed independence is essential to the public interest because it allows us to make tough decisions insulated from short-term political pressures. At the FOMC meetings, each committee member presents the current outlook for his or her region and for the nation as a whole. Now, for these assessments, we consult our researchers and add critical information that we learn from listening to people like from our board of directors, regional advisory councils, community leaders, such as you and others that I'll meet on this visit. This trip includes a meeting with the Long Island Housing Partnership and a visit to some distressed neighborhoods, a tour of the D'Addario String Factory. You know, I actually worked on that on the ride over, and I still messed it up. And lunch with its workers, and a tour and meeting at Brookhaven National Laboratory. At the New York Fed, we continue to track conditions in our district, and we have created a number of tools for that purpose. For example, my staff produces monthly indices of economic activity for New York City, the entire state of New York, and for New Jersey. These indices are essentially measures of local outputs, so they're similar to gross domestic product at the national level. These measures provide a more complete gauge of activity than the employment report, which is another metric that's available at the state level. We've also constructed a consumer credit panel to track local household credit conditions, including the amount and type of personal debt that people have and whether that debt is payments are being made in a timely way. In addition, we have a periodic poll about the credit needs of small businesses, which are an important source of new jobs. We're just launching our latest survey. It includes questions about the skills needed that small businesses need and the right kinds of skilled labor that are available for them. Almost 900 regional businesses responded to our last poll, of which roughly 5% were from Long Island. So if you are part of a small business, would like to participate in the current poll, Please pass your card to one of my colleagues who are in the audience or see me after the speech, and we'll be glad to add you as a respondent to our poll. In December, we hosted a workshop for small businesses in New York City to provide information about how they can export their products and services. The Export-Import Banks, the Small Business Administration, and the U.S. Department of Commerce were on hand to tell participants how to tap the demand for the global marketplace and what government programs are available to enhance credit and to increase their lines of working capital. In 2012, we're further developing our small business program. We hope to partner many of you to support the small business sector. Now, as you know, even states as wealthy as New York have some large pockets of poverty. So we also target some key initiatives specifically to low and moderate income households. Here on Long Island, there are pockets that have suffered greatly in the recession. In Nassau counties, communities such as Hempstead, Baldwin, Roosevelt, and New Hyde Park have had foreclosure rates over 4 times as high as the national average. The same holds true for parts of Brentwood, Central Islip, and Patchogue in Suffolk County. We have worked hard to help neighborhoods that face high foreclosure rates. Over the past 3 years, my staff have come to Long Island to meet with housing counselors and legal service practitioners. We have provided housing advocates with the latest information about mortgage conditions via mortgage briefs, roundtables, presentations, and newsletters. We've also developed an online resource that shows delinquency and foreclosure conditions in neighborhoods each month. We believe this site will be useful in aiding the work of housing counselors and other parties seeking to help their communities. To share what we learn about our diverse district, we have a website with detailed information about the region. I invite you to visit newyorkfed.org, that's newyorkfed.org, to explore our highly localized maps and information on small businesses, credit and housing conditions, and even the latest job openings at the New York Fed. Finally and crucially, in the aftermath of our financial crisis, we're working with our colleagues in Washington, D.C. and at other regulatory agencies to help put the nation's financial system on a firmer footing. Much has been done, yet much remains to be accomplished here, and we're determined to keep at it. I recognize fully that there can be no return to pre-crisis business as usual, whether on the part of the financial sector or on the part of regulators like ourselves. All in all, I have a lot to keep myself and my colleagues busy. So now let me turn to discuss national economic conditions. The incoming data on the U.S. economy have been a bit more upbeat of late, suggesting that the recovery may finally be establishing a somewhat firmer footing. Real GDP expanded at a 3% annual rate in the fourth quarter of 2011. That's the fastest growth since the first half of 2010. The average monthly gain in non-farm payroll employment also picked up. 250,000 jobs added in January. In February, that's up from 164,000 jobs a month in the fourth quarter of last year. Sales of autos and trucks have also risen to a seasonally adjusted rate of a bit over 15 million in February. That's the highest rate of car and truck sales since early 2008. The ISM non-manufacturing index rose for the 3rd consecutive month in February, now stands at its highest level in more than a year. Even the housing starts data has firmed up somewhat, although obviously from very depressed levels. Now, while these developments are certainly encouraging, it's far too soon to conclude that we are out of the woods. To begin with, the economic data did look brighter at this point in 2010 and again in 2011. Only to fade as we got into the second and third quarters of those 2 years. Moreover, the U.S., as we've experienced today, has been having unusually mild weather over the past few months. The number of heating degree days on January and February were 17% below the 5-year average, and March is actually milder relative to a normal March than January or February have been. So while this reduces the amount of households and businesses must spend on heating, which is obviously welcome, I expect that it's actually boosting GDP as a whole because there's more construction activity and other activity that's undertaken because of the very mild winter. More importantly, real economic activity is yet to be strong enough on a sustained basis to make a big dent in the overall amount of slack in the U.S. economy. While it's true that growth was stronger in the fourth quarter, most of that growth was due to inventory accumulation. Growth of final sales was actually quite weak. Historically, a quarter in which inventory investment makes a significant growth contribution is typically followed by a quarter in which the growth contribution from inventories is either very modest or even negative. And that appears to be what is shaping up in the first quarter of this year. Based on the available data for the first quarter that we have to date, it looks like that real GDP will expand at about a 2% annual rate during the current quarter. Despite the increase of light motor vehicle sales, overall consumer spending has been sluggish. While growth of retail sales in February was reasonably strong in nominal terms, it was considerably less impressive when large increases of gasoline prices that occurred last month are taken into account. Based on the data for the first half of March, gasoline prices are continuing to move higher. This is a negative which will further sap consumers' real purchasing power. And growth of business fixed investment, which had been quite strong in the second and third quarters of 2011, entered the new year with little forward momentum. To put the recent pace of growth into perspective, we believe that the economy's long-run sustainable growth rate, what economists call the potential growth rate, is about 2.25% per year. So if you can see, adding the fourth quarter and the first quarter, we're growing at about 2.5%. That's barely over the country's long-term perspective. Although the sharp decline in the unemployment rate from 9% last year to 8.3% in February suggests we are doing a bit better than that growth rate suggests, it's important to recognize that about half the decline that we've seen in the unemployment rate is due to a declining labor force participation rate. In other words, people are no longer looking actively for work, so they're not counted as unemployed. In fact, had the labor force participation rate not declined from around 66% in mid-2008 to under 64% in February, the unemployment rate would still be calculated to be above 10%. Also, it appears that productivity growth has slowed down sharply recently. Although that means that a given amount of growth leads to more employment gains, it's certainly not an unmitigated positive development. Also, we cannot lose sight of the fact that the economy still faces significant headwinds, and there are some meaningful downside risks. In the headwinds department, I would include the run-up in gasoline prices I mentioned earlier, because that will sap purchasing power. The continued impediments to the strong recovery of the housing sector is another problem, and the fiscal drag that we see at the federal and state and local levels. In terms of downside risks, these include the risk that growth abroad disappoints and the risk of further disruptions to the supply of oil and higher oil prices. On the inflation front, the overall rate of increase of consumer prices, as measured by the 12-month change in the Consumer Price Index, has slowed to 2.9% in February on a year-over-year basis from the recent peak of 3.9% in September. Despite the recent rise in gasoline prices that I mentioned earlier that may interrupt this pattern of the decline in headline inflation, we expect this moderation in the growth rate of consumer prices to resume later this year when the gasoline price spike is behind us. While underlying core inflation rate that strips out volatile food and energy prices has also been somewhat higher than we expected a few months back, it appears that the annual rate of core inflation has peaked, and we expect to begin to see it decline later this year. Finally, inflation expectations, which play an important role in the inflation process, remain well anchored. By this I mean that people expect that the rate of inflation will be relatively low in the years to come. So how about the regional economy? How is the recovery proceeding in the state and region? Well, as I mentioned, the New York Fed produces indices that help track economic activity in this region. Based on these measures, the economic recovery got underway in both New York State and New York City in late 2009, and economic activity has continued to expand through early 2012. New York Fed also conducts the monthly Empire State Manufacturing Survey to monitor conditions for regional manufacturers. The most recent survey, for which a number of Long Island firms participated, points to a continued expansion in manufacturing activity through the first quarter of 2012 and heightened optimism about the general business outlook. Recently released employment revisions indicate that an economic recovery has taken hold here in Long Island. But there's still a long ways to go. Employment on the island declined about 4% during the downturn. That's a steep drop, to be sure, but only about 2/3 as steep as the decline that occurred nationally. Since bottoming out in late 2009, employment here on the island has rebounded by almost 2.5%. So we've come back a bit more than halfway to the peak that we reached in early 2008. Moreover, these job gains have occurred despite ongoing job losses in local government. While other parts of the region sustained job losses in local government starting in 2010, Long Island's job losses in local government just started in the spring of last year, and that's created a drag on the labor market overall. Nevertheless, the private sector has picked up the slack. This is most pronounced in professional and business services, finance, leisure and hospitality, and in healthcare. Even the island's manufacturing sector has added jobs over the last year. Another sign of recovery that is taking hold on Long Island is that the banks that were created just before or just after the financial crisis, while they're only a small part of the overall market, are starting to show signs of growth. Now, Long Island's labor market has also been aided by its proximity to New York City. With a large portion of the island's workforce commuting to New York City, especially from Nassau County, the brisk job creation we've seen in the city has helped matters here as well. Unemployment here on the island topped out at 7.6% in late 2009, and it's hovered around 7% over the past year. Now, that's a high rate for sure, but it's well below the national and state levels. Turning to the housing market, there things here are more dreary. After more than doubling between 2000 and 2006, home prices on Long Island are down more than 20% from the peak, and prices have yet to show any clear signs that they're bottoming out. This weakness is underscored by our latest quarterly consumer credit panel data. This data shows that mortgage delinquency rates on the island are much higher than in other parts of the state, and these delinquency rates continued to edge higher in the fourth quarter of last year. The housing crisis has also been important here because it's put pressure on local school finances. Historically, the island has been heavily dependent on local sources for its school funding, and the housing debacle has generated a sharp drop in local property taxes. State aid has generally been insufficient to make up for these losses, and school administrators have been forced to cut both instructional and non-instructional spending. Now, despite some of these ongoing problems, I believe that the long-term outlook for Long Island in terms of economic growth is actually quite positive. The good news is the island's workforce is particularly well educated, with over a third of the adults holding a college degree. It has a sizable industrial base, which is concentrated in high-tech manufacturing. And as Kevin and I discussed before, there's lots of important assets like Brookhaven Labs and Cold Springs Harbor Laboratory, as well as a fine array of academic institutions, which provide a strong foundation for the island's tech sector and the business sector more broadly. The recent move, I think, to create stronger ties between the business community, the research labs, and the State University of New York is a welcome development. It has the potential to help leverage the island's existing assets to enhance its prospects for future economic development. So to sum up, the incoming data on the U.S. economy has been a bit more upbeat of late, suggesting that the recovery may be getting better established. But while these developments are certainly encouraging, it's far too soon to conclude that we are out of the woods in terms of generating a strong, sustainable recovery. On the inflation front, the year-over-year rate of consumer price inflation has started to come down in recent months. And despite the recent rise in gasoline prices, we expect inflation to moderate further when we get deeper into the year. Looking ahead, the key challenge for the Long Island economy will continue to prepare its residents for the best jobs being created here, expanding educational access and opportunities, and the skills that go along with it will go a long way to broadening the participation in the economy to all residents and bolstering Long Island in the future. Thank you very much for your kind attention. I think Kevin's going to ask me a few questions, and then we'll open up to the audience. Thank you.
Do you want to take the questions from here?
You can take it from here.
Okay. Great. Well, thank you very much, Mr. Dudley. As I said, we'll take some questions. I'll get the ball rolling, and we'll start with interest rates. The Fed has said they were going to keep interest rates low through 2014 in light of the the improved numbers over the last several months. Do you see the Fed sticking to that timetable of keeping rates low through 2014, or might they increase sooner than that?
They might increase sooner, they might increase later, depending on how the economy evolves. I mean, we are where we are. I mean, we're looking at the economy, and we're going to continue to assess what's appropriate in light of economic conditions. So, this is a forecast of what we currently anticipate we're going to do. If the economy were to change in a meaningful way, then obviously we would change our forecast. But that's a two-sided risk.
Gotcha. Thank you. And I didn't hear you mention the European debt crisis and what the presidential election this fall, how might that impact the Fed's decision-making coming down the road?
I would say that the political election has no bearing whatsoever on how we carry out our policy, and that's the way it's supposed to be. We try to, the Fed is insulated from political pressure. That's why the central bank is independent. Now, obviously, we do carry out the mandate that's set to us by Congress. The dual mandate of maximum sustainable employment and price stability is set to us by Congress. And if Congress were to change that mandate, then we would change how we conduct monetary policy. But besides from that, we are pretty insulated from political pressure on a day-to-day basis. So I would say the election has no bearing whatsoever on terms of what we're going to do in terms of monetary policy.
Depending upon what happens in November, Tim Geithner has said he wants to come back to New York and leave the Fed. I know the president has talked him into staying for a couple of times so far. But if he does leave, either voluntarily or involuntarily, at the end of the year, what do you think Tim Geithner's legacy will be?
Well, as my former boss, I have to be very complimentary. And I actually saw Treasury Secretary Geithner last week. He was speaking at the Economic Club, and I got to talk to him and his wife, Carol. Look, I'm a big Tim Geithner fan. I mean, he did a great job during the financial crisis for the New York Fed. He basically led the efforts to develop very innovative and successful devices to support the financial market functioning and the financial system right in the middle of the crisis. I'm not going to opine on his performance as the Treasury Secretary because I think there's a political element to that. But I think I have tremendous respect for him. He did a great job as the president of the New York Fed and as my boss during that period.
Likewise, what do you think Ben Bernanke's legacy will be?
Well, I think there was an interesting article in Atlantic magazine this week about Chairman Bernanke. He's actually on the cover. And I think what one person in the article, the article is a very complimentary article, and I think the chairman does deserve all those compliments. But deep in the article, someone said that the real legacy can't really be determined for at least another 5 years. You can't really determine how well someone is doing in real time because you have to see how the story plays out. So look, I'm a big fan of the chairman. We have a great working relationship. He and Tim, in the middle of the height of the crisis, performed heroically, in my opinion. I think I agree with the whole gist of the Atlantic story, but I do think it's really too soon to take victory laps or decide what someone's reputation is likely to be. History will take care of that. We have plenty of time to sort all that out.
Well, very good, and thank you very much for the compliments and the endorsement of our initiative of Accelerate Long Island, where we are looking to really create some new employers for our region. Is there anything the Fed can do to help us with that initiative?
Well, we have actually been talking to educators and business people about how to forge that partnership. So we would like to pick your brains and maybe find out what ideas work for you, and then we will share what we learn from others. So we've had some of the similar conversations with people upstate New York, at Cornell and SUNY Albany and Syracuse University, Rochester. So we think this is hugely important for the region because if you look at New York State as a whole, it has incredible educational resources relative to the rest of the country, yet we're not really getting the jobs from those resources, in the sense that these universities develop a lot of innovation, but then the jobs associated with those innovations have essentially gone elsewhere. And that's partly because the educational communities haven't really thought of, gee, this would be actually a good idea if we could actually partner with businesses in our region and keep the jobs here. They just that really hasn't been part of their mentality, and I think it's important that we educate them and get them on board working with businesses, and I think it's a very collaborative process, and I think it has a very high prospect of success if it's done correctly. So this is something I very much endorse.
Great. Well, thank you very much, and we're excited about it. We'll be meeting with two of our partners later on today, Sam Aronson from Brookhaven National Lab and the folks over at Stony Brook University, and we look forward to working with your staff on getting you more information. Sam?
Hi, Sam Aronson from Brookhaven National Laboratory. Just to follow up your last point, it's not so clear to me. It's simply a matter of educating the educational system in the state, because jobs do get created on Long Island through businesses that are started on Long Island, through the intellectual property that's generated by the research labs and the universities, but they don't stay here. And that's an issue for a different conversation, I think, about policies in the state that actually are friendly to startup companies, which I think we're lacking in.
Well, I mean, there's no question that the New York State region, broadly writ large, is a higher cost place of doing business, and so what you have to have are benefits that are commensurate with those higher costs, and those benefits can include the access to New York City. They can include having very, very high intellectual attainment in terms of the workforce. They can include just the the rich and depth of leisure activities and things that people can do to keep them here. So I think there are a lot of things that can be done to overcome some of the disadvantage of being relatively high cost place for doing business.
Yes, Carl?
Hi, I'm Carl Camber. I'm the economist here for the LIA. I'd like to take you back to interest rates for a moment. We've kept them close to zero for a very long time, and the argument has been made that this gives savers very little interest on their money. We are a highly consumer-oriented economy, both nationally and here on Long Island. Can you address the balance between stimulating consumer spending and at the same time working to save the economic recovery?
Well, the Federal Reserve has basically been keeping short-term interest rates exceptionally low for a very obvious reason. We're trying to stimulate financial conditions that and therefore be supportive of economic growth. And the more successful we are in terms of stimulating the economy, the shorter the period of time will be when short-term interest rates are exceptionally low. So, we understand that this is a problem for savers. I mean, my mother, who's 89 years old, complains to me about the level of interest rates. So we certainly understand that. But I mean, the choice is not interest rates low or interest rates high. The choice is between interest rates low now, so we can get them normalized sooner rather than later. So I think we view that this is the best path to the earliest possible economic recovery. And if we can have the earliest possible economic recovery, that means the earliest normalization of short-term rates to more normal levels, and that's what we're trying to achieve. Even though obviously the current level of rates is tough on savers.
Okay. We have time for one or two more. Back here, Mr. Palermo again.
Yeah, thank you. Given the current debt situation, could you weigh in on fiscal stimulus versus the fiscal austerity sort of debate that's going on in the country and around the European situation? There seems to be quite a debate in that area. I'd be curious as to your opinion.
Well, the question is, can you solve a debt problem by austerity? And I think the answer is austerity may be needed to a degree, but in Europe you also need to make structural changes to your economy that also improve your competitiveness. So for Europe, there's two pieces. One, fiscal restraint that gets the federal budget, the deficits on a sustainable course, but also steps that improve labor competitiveness. In the U.S., I think the Federal Reserve officials, the chairman and myself, have been very clear what we think is important is a credible long-term path of fiscal consolidation. And that's what we need, something that's bipartisan so that people feel that it's really something that's sustainable. And if we have that in place, then I don't think it's necessary to have a lot of fiscal restraint really early at a time when the U.S. economy is still quite weak. But you need to have that credible long-term fiscal program in place, which we're sort of edging towards, but we certainly don't have one in place yet.
Jim?
Yes. Are you surprised, sir, that with the price of a barrel of oil so high, that inflation isn't greater?
I would say, no, I'm not surprised that with oil prices so high that inflation hasn't gone up very much, because I think that for a couple of reasons. One, well, gasoline prices are very visible and apparent when we at the pump when we go there every couple of weeks. The reality is, if you look at the share of gasoline prices in the average household's budget, it's something on the order of about 5 or 6% of their budget. So, the prices of everything else also have a great deal of weight. So I think that's the most important thing. The second thing is, I think that there's a lot of slack in the economy still. I mean, the unemployment rate's still 8.3%. So the upward pressure on prices caused by rising gasoline are offset by the downward pressure on prices caused by all the excess slack in the U.S. economy. It's very hard to have an inflation problem when compensation costs are rising quite slowly, which is the current case.
Thank you.
I need to see to consider a QE3.
Did everybody hear the question?
The question is, what does the Federal Reserve need to see to do another program of quantitative easing? So QE3 was the question. Obviously it depends on how the economy evolves. I mean, up to now we have not done another program of quantitative easing. We're in the middle of what's called the maturity extension program, or what the press like to refer to as Operation Twist, in which we're selling short-term Treasury securities in our portfolio, and we're buying longer-term Treasury securities in our portfolio, designed to push downward pressure on long-term interest rates and thereby stimulate the economy. Nothing has been decided. It all depends on how the economy evolves. It's about costs and benefits, and if we get to a point where we think the benefits of another program of QE outweigh the costs, then we'll certainly do so. But those costs and benefits are not immutable. They depend they depend to a great degree on how the economy actually unfolds.
Okay.
If you care to comment on the effect that the cooling off of the Chinese economy, to the extent it's happening, might have on the U.S. economy in terms of Fed policy?
The Chinese economy is growing a bit more slowly, but remember, this is from an extraordinarily torrid pace. So the Chinese authorities lowered their long-term growth forecast to 7.5% going forward. But typically, in recent years, they've always outachieved their projections. So I would say that the slowing so far that we've seen in the Chinese economy is pretty modest, and probably mostly associated with two things: one, the slowdown in Europe. And two, they have a bit of a property bubble themselves in terms of overbuilding, in terms of housing. But I think that China is still very much poised to grow, and so I think that the effects of this very modest downtick in the growth rate in China is going to have very small effects on us. It's not something that I worry too much about.
Bill, as a former Goldman guy, what do you make of the whole hullabaloo last week, Greg Smith and his attack on not just the culture of Goldman, but the culture of Wall Street these days? A cheap shot as he was walking out the door, or what?
Well, I've been gone from Goldman Sachs for quite a few years now, so I left at the end of 2006, so it's hard for me to judge what's happening there or not happening there. So I can't really speak to his observations. I mean, I think it's fair to say that the financial system has moved it from the genteel world of investment banking, more in the direction of the less genteel world of trading. The trading businesses are quite tough, hard-nosed businesses, and I think that there's a real question about where the line is between not legal behavior or illegal behavior, but what I would call ethical behavior and unethical behavior. And I think that's something that needs to be debated. What's fair in terms of what kind of things can I do vis-a-vis my customers in terms of selling them complex financial products. I think that's a discussion that we should be having.
Right. Good point. Thank you. Last two questions, right? Ken and Paul.
Actually, wasn't going to ask a question. I just want to thank you, Kevin, for 2 great weeks in a row of first Michael Bloomberg and now Mr. Dudley. These are great programs, getting programs of insight. So I want to thank you and the board for your leadership and bringing these programs to us.
Thank you very much, Ken. We appreciate it. How do you like our new sign? How do you like our new logo? Well, very good. Thank you. Pearl, I should have ended with Ken, but no.
One more question. We seem to have a lot of structural unemployment in the economy. This is growing. The jobs are growing, but the skills aren't there. This is particularly true on Long Island, where many of our tech firms can't find the workers they need. Are we moving toward a new normal in terms of the level of unemployment? In other words, will the permanent level of unemployment be higher than in the past?
There's a lot of discussion about this potential prospect. In other words, people who have been unemployed a long time, eventually their skills atrophy and then they're structurally unemployed, and so they're never going to find work again. We've done a lot of work on that on an ongoing basis, and so far we don't really see that much evidence that that people who have been out of work for a longer period of time have a significantly, are losing their ability to find jobs. We actually find that the people who are long-term unemployed, even though it's very difficult for them and their families for sure, it doesn't look like we're seeing significant structural employment at this point. Now, we're still early in this process. I mean, the unemployment rate's 8.3%, so I wouldn't want to prejudge this issue. What it speaks to me, though, is about the importance of education and job retraining efforts to make sure that these people don't become structurally employed. I mean, I think I'd want to take the question, and rather than say we just have to sit here passively and accept whatever happens, I think we can do something about it in terms of how we actually help people who are unemployed for long periods of time, how we help them to find work in the future. I don't think that's a foregone conclusion one way or the other. I think it's going to depend in part upon our actions, and so it behooves us to work on that to the extent that we can.
Right. We always hear about the Fed, Federal Reserve, the Fed, and it's so nice to see a face behind it, a likable guy, a smart, articulate, it just really makes us feel good that there are people like you behind the Fed that we always read about, talk about. So, ladies and gentlemen, William Dudley.